Yo, what is up, you guys? Little Stocks Bro here, giving you your weekly update on the options account. The account, as you can see, is sitting at 8,500 bucks. We are officially under the 10K mark. And even though today was a nice green day, up about 1,200 bucks, this week was a very bad week for Alibaba. Alibaba, if you check to see here, we started the week at around 12K. It gapped down starting Tuesday, went down further, had a little bit of an uptick, went down some more, and then yesterday, Thursday, it gapped really low, breaking below $200. At this point, it was when I was below $200. I'll show you that in a second. And it all has to do with the fact that this company Didi that went public, the Chinese government is now putting pressure on them, and it kind of revitalized this fear that people have when it comes to the Chinese government and how they handle companies within their markets. So if we take a look at Alibaba, we'll see how it moved this past week. So here's Alibaba today. It had a very nice day, up $6 on the day, 3%. A 3% move for Alibaba is a really nice move. So in line with my portfolio, Alibaba started off the week at around $212, slowly lost it all, went down to about $208. Then there was the huge drop. Here it fell to $198.99, broke below 200 for a little bit, came back up around 200 bucks, and then consolidated there for the rest of the day. And then it was only today where it gapped up and slowly made its way back up to around $206 where it ended the day. So if we take a look at my position, we have 9 contracts now, about 1 contract this week, a value of $8,500. Today we're up $1,200, total return negative almost 9K. Basically the same as last week, not too much has changed. So we'll take a look at the securities sheet, and then at the end I will show you guys the chances of you making money depending on the length of the contracts that you guys have. And that's actually really interesting to look at. And I think that's something a lot of newer people should see so they can get a sense of the differences between and how important it is to have time on your options contracts. So let's check the security sheet out really quickly, and then I'll show you guys the charts that I made. Okay, guys, so here's the sheet. If you want to look over it more on your own in detail, you can just pause the video, but I just want to go over some key points. It's basically mostly the same as last week, but some key things I want to point out from the sheet is, first of all, this H column here. If you can see, the expected has changed dramatically. So especially for the 2-month contracts, we went from negative 2,000 to negative 3,200. And so you'd ask yourself, why such a huge change in expectations from week to week? Well, basically it's because of the change in price of Alibaba from week to week. Now this past week was a huge change, and I'll update the expectations week by week. These expectations are based on my sell targets, my sell points for these contracts. And one thing I want to keep in mind, for you guys to keep in mind, is I'm selling these contracts not for a profit. Now, I've been saying this for a long time. This isn't what I want to profit and sell and be done with it. Again, we're trying to flip these contracts, so we're trying to turn these two-month contracts into one year out contract. That's basically what we want to do. We're not selling it for profit. We're selling it to get the capital that's invested into those contracts back and flip those into better longer-term contracts. But if we take a look at the column to the right, Alibaba last week ended at $217. This week it ended at $206. That's an $11 move in 1 week. Now you might say, what's the big deal? Not that much. Well, you have to take into account the size of Alibaba, because that's what really matters, and that's what really shows you exactly how much movement you're having in these companies. Now, Alibaba is a super huge company. It's a very, very large company. It's one of the largest companies in the world. So even though its stock price is only $200, don't let that confuse you. A lot of newer people get confused. They see Amazon's worth $3,700 per share, and Alibaba's only worth $200. So there's a huge discrepancy there. Well, there isn't. Now, Amazon is a lot more valuable than Alibaba as a company, but they're not that far apart, even though their share prices are very far apart. So currently, Alibaba is at $555 billion in market value. Last week, when it was at $217 per share, it was at $630 billion in market value. That's an $80 billion change in 1 week. So $80 billion of value from Alibaba was gone, evaporated within 1 week. Just so you can understand, how big of a change that is. You know what other companies worth about $80 billion? We'll take a look. Uber is. Uber has a market cap of just about $90 billion, 90 billion-ish dollars. So this week, what happened to Alibaba was the same as if Uber, the entire company, just disappeared. That's how much value was quote unquote lost. Now, of course, market fluctuates all the time. You'll probably get that value back. Alibaba will get that value back over time. But that just gives you a sense, an idea of what type of movements it is we're dealing with when it comes to these behemoth of companies. It's an $80 billion movement. So just keep that in mind. So the last few things that I want you guys to focus on are, first of all, this K column over here that I added, the average break even of all the contracts and the average time of all the contracts. The time is currently 3.6 months. If you look over to the right, 3 to 6 months, that's poor. So we definitely got to get those up. Obviously, these 2.5 month contracts are contributing to that. Once I get rid of those, that should take a nice bounce up. And then the average break even for the contracts, a little high, above 240. I would like to get it under 240. Next week, I would definitely be buying one more contract. So if you see, we had 8, now we have 9. Next week, we'll hopefully have 10. I'll buy my 10th contract, hopefully under $210, and that will help get the break even below that. So if next week is a nice week, we should get the average months to about 5 and the average break even maybe to 239, get it a little bit below $240. And then we'll be rocking at a nice position there and have 10 contracts. And then obviously the account will be a little bit higher, but the account, that's whatever. That fluctuates greatly from week to week. So 8,000 this week, 13,000 the week before that, and the week before that I was at 17,000, and then the week before that I was back at 8,000. So the account fluctuates a whole bunch. It's the contracts, and now this column over here, the average break even and the average time on the contracts. Those are the 3 key things that we have to pay attention to looking forward. So that being done and out of the way, I'm going to show you guys your chances of success depending on the amount of time you have for different contracts. So check this out, guys. This is very important. All right, guys, so what I've done is created 4 different charts to show you guys your chances of making money off of options contracts depending on how much time you have left on those contracts. I've broken those down into 6 different categories. You have your big money, which is doubling up your money, good money, which is making between 20 and 100%, okay money, which is break even through 20%. Then you have your small loss, which is 20% or less, your big loss, 20 to 90%, and then losing everything, like 100% loss, your contract goes to 0, which is what happens to the majority of contracts. Now, of course, you can sell your contract out at any time, so this isn't perfect. This isn't based on any actual mathematics. This is basically just a rough estimate, a rough idea, so you guys can visualize, the more new people to contracts, so you guys can visualize what it is your chances are depending on how much time you have left on your contracts. So starting with this 2-year contract, what it basically says is your chances of making money are very, very high. And of course, it would make sense that you'd be more likely to make 20% on your contract rather than double up on it. Therefore, the chances of it go down as you make more and more money. And then on the other end, these are the 3 bars over here, are the losses, and the losses are very, very low. Your chances of losing money on a 2-year contract are very low. Now, of course, guys, this is contingent on the fact that you know what you're doing and you're not buying a 2-year contract on something like, GameStop when it's at $400 a share, or AMC when it's at $100 a share. This is you knowing what you're doing, being savvy, buying a 2-year contract on a very, very good company when it's beaten down and near a support. Like Alibaba, near $200 support, and of course it's contingent that you know what you're doing. If you know what you're doing and you're buying, a good company with good fundamentals, when it's beaten down, if you buy a 2-year contract on that company, the chances that you'll lose money on it, very, very low. The chances that you will sell for a loss are low, because you won't need to sell for a loss. You'll have plenty of time for that contract to get into the green, whether that's 20% green or whether you have a huge rally, you're able to wait and you get double up your money. The chances you make money are very high. Chances of you losing money or selling on a loss, I should say, low. From the 2-year contract, let's jump to the 1-year contract. Boom. So if you take a look at the differences in these contracts, just take a look at the difference in the bars. What ends up happening? What ends up happening here? What ends up happening on the 1-year contracts, your chances of losing money increase. Your chances of making money stay just about the same. They're a little bit lower, but your chances of losing money increase. So it's about even. That's just the 1-year contract, basically the same thing. And then if you move to the 6-month contract, what happens there? Well, it starts shifting, as you can see. It starts shifting. So From the 1-year contract, your chances of making money are high. Your chances of losing money are also high. From the 6-month contract, you're cutting your time in half. So you have to understand that your chances of losing money at this point really high. And another thing you have to take into consideration is the shorter amount of time you have, the less the fundamentals of the company come into play in the market. So short term, remember when you're dealing with the stock market, short term, anything can happen to the valuation of the stock. Like I mentioned earlier with Alibaba, it lost in 1 week $80 billion worth of value. So short term, anything can happen. You have to be a long term minded in order for the fundamentals of the companies to take into effect, because it's over time where the fundamentals match up with the price action of the stock. So if you're short minded, you have to keep in mind short term minded, you have to keep in mind anything can happen, and it slowly starts becoming more and more gambling, less and less investing, which is why once you cut, you have to notice you have a 2-year contract, you cut that time in half to 1 year, and then you cut in half again to 6 months. 6 months is not too much time when it comes to the stock market. Anything can really happen. So your chances of losing money or selling on a loss on these contracts, very, very, very high. And so now from 6 months, I'm going to cut it down to 1 month. There's a lot of new traders, not a lot of new options traders I've noticed from the statistics in Robinhood that are trading very, very short-term contracts, sometimes even 1-month contracts. And that's what I was doing at first. When I didn't know what I was doing, I was trading 1, 2, and 3-month contracts. I still have a few 2-month contracts and short-term contracts, but I didn't buy them at 2 months. They slowly became 2-month contracts after holding them. But there's a lot of new traders that buy these 1 and 2-month contracts, trying to make their money. Now, take a look at what happens to the chart. This is actually very interesting, and we want to explain why it's such a dramatic difference between the 6-month and the 1 month. And also keep in mind, going from 6 months to 1 month, you're not just cutting it in half, you're cutting it, 6 times. So it's 1/6 the time of a 6-month contract, which is already bad. But take a look at what happens. The 1-month contract, your chances of doubling up skyrocket, way higher than the 6-month contract, higher even than the 1-year contract. Your chances of doubling up your money on the 1-month contract are very, very high, which is why a lot of traders try and get into these short 1-month contracts. They're also very, very cheap, but there's a catch. What is the catch? Take a look at the chances to lose all your money. Also very, very high, even higher than your chances to double up. And then your chances to make anything in between, very, very low. Should actually be a little bit lower than that. I should have adjusted the graphs to make it very, very low. And so why does this happen? How is that possible? How is it more likely for me to lose everything than, say, lose just 20%? Well, here's the catch, and here's what a lot of people forget. Your underlying stock can gap up or down pre-market, and you are unable to sell your contracts pre-market. You have to wait until the market opens. So if you have a huge gap down, that's going to dramatically change the price of your contract. And your contract being 1-month contract or less, you don't have time to get it back. And then on top of that, you have theta decay, which is basically the amount of money you pay to own that contract. And the closer it gets to expiration, the higher the theta decay. So for a 1-month contract, you're going to be paying a lot of money each day to hold that contract when you don't have time for it to regain the value that it could potentially lose instantly if the underlying stock gaps down. So once you get it down to a 1-month contract, you have to understand your chances of doubling up, really good. Your chances of losing everything, really high as well, which is where the gambling aspect comes into it, and that's what a lot of traders are into. That's what a lot of people like to do. They like to buy these cheap 1-month contracts and hope to hit a home run and double up, or they lose everything. And these contracts, like I mentioned, they are very cheap, so you won't be paying a lot of money for them. You could, depending on what stock the underlying stock is, you could pay $100, $200 for these 1-month contracts. It's not a lot. But that's what people get into. It's not what I would recommend doing. It's not a sound strategy. It's not investing at all. At that point, it is gambling. But I just thought it was really interesting to point that out to people. So I hope you guys were able to take something away from that. Hope you found it interesting. If you have any comments on it, you can leave it down below. I'll respond. And yeah, that's it for this video. It's a longer one, but I just wanted to get this in there because I did check the statistics out, and options trading, especially short-term options trading, is very popular right now. So it's very important to keep these things in mind when doing so. But anyways, guys, I'll see you guys again tomorrow with the next week with the next update video. Until then, peace out.